Welcome to the Deep Dive. Our mission today is to cut through the noise of earnings season and really deliver you the essential story from Bank7's Q4 2025 performance.
Yeah, this call was on January 15th, and it really laid out the roadmap for a bank navigating what is, a very tricky interest rate environment.
Exactly. We've gone through the materials and we're ready to unpack the key financial beats and the management commentary that's really going to define 2026 for them.
Let's just jump straight into the financial snapshot because it was a solid performance.
It really was.
Bank7 delivered a definite earnings beat. GAAP EPS came in at $1.12.
$1.12. Okay. And what was the street looking for?
The consensus was about 105, so that's a pretty significant beat of, about 6.7%.
Right.
Which for a regional bank is, fantastic.
And what about the top line, the revenue picture?
So revenue, which we're kind of proxying from their net interest income after provision plus non-interest income, that totaled roughly $24.1 million.
So just a marginal beat there over the $24.02 million estimate. A great EPS number, but maybe driven more by control than a huge revenue surprise.
Right, and it's important to see the nuance there. Net income for the quarter was $10.78 million. And that was actually slightly down compared to the prior year's $11.11 million.
Yeah.
But, management was quick to pivot away from that.
Right. They wanted to talk about the profitability metrics. That's where the real story starts.
Exactly.
Because despite that small dip, the profitability is, frankly, robust. We're looking at a return on average assets and ROAA of 1.75%.
And this is the big one, a return on average equity, ROAE, of 18.49%.
18.5% ROAE. For you, the learner, that is the money they generate for every dollar shareholders have invested. And in this space, that's top tier.
Oh, top tier. And that performance, it sets up the core tension of the entire call. They're delivering these high-octane returns, but they have this very specific, almost counterintuitive capital strategy.
We'll definitely get to that. But first, we have to talk about the engine driving those returns, the net interest margin. The NIM.
Right. So excluding loan fees, the NIM came in at 4.45%.
Which is slightly lower than the 4.48% from last year. But management really hammered home that this margin is still near historical highs.
Yeah, it sets a very strong base for the new year. But that slight compression, that's what we really need to dig into.
Okay, so let's unpack that growth engine. This is a relationship-driven commercial bank, right?
Absolutely. High touch. And the Q4 results, they just reinforce that story. I mean, management kept using the word outstanding for their loan and deposit growth in their core markets.
And those core markets are Oklahoma City, Tulsa, and the Dallas-Fort Worth area.
Exactly. And the numbers, they really are stark. Loans held for investment grew 12.3% year over year.
12.3%, up to $1.5 billion.
Yeah, and deposit growth was solid too, up 7% to $1.72 billion. And that's what pushed their total assets past that, important $2 billion mark.
That's just massive organic expansion.
It is. But that growth brings a real operational challenge. One of the execs called it a snowball rolling down the hill.
A snowball rolling down the hill. I like that. What do they mean by that?
They meant they have to generate a huge amount of new business every single month just to offset the rate of payoffs. They need something like 35 to 45 million in new fundings a month.
Just to stand still, essentially.
Just to offset the payoffs, which they think will be around 25 million a month this year. I mean, that kind of flow requires just relentless discipline.
And this is where that sustainability question comes in. This is the defining theme for 2026. Management was celebrating the snowball, but they also admitted that replicating 2025's growth rate this year would be difficult.
Very difficult. And they were super clear that the constraint isn't capacity. It's competitive pressure on loan pricing.
On pricing.
Yes. They stressed, and I mean stressed, they will not sacrifice underwriting discipline for volume. This isn't a slowdown because the market's bad. It's a slowdown by choice.
That's a key nugget for you to take away. But doesn't that inherently mean growth is stalling? I mean, how credible is that claim of ironclad discipline?
Well, that is the tightrope, right. But I think it's credible because they can point directly to the margin discussion.
It ties right back to the NIM.
Exactly. That immediate tie back to the compression in NIM down to 4.45, it shows that pricing competition is already biting. And they even signaled this last quarter, saying they were coming off an all-time high.
The CFO gave some really fantastic color on the rate outlook, said they had a couple of rate cuts, and they feel like they've hit an inflection point where a lot of their loans are finally hitting their floors.
Right, which helps defend the margin.
Hey.
But he also acknowledged that deeper cuts, say a cumulative 75 basis points from the Fed, could push the NIM even lower.
How much lower?
He was very specific. Their historical low NIM was around 4.35%. And he said if the Fed delivers those deeper cuts, it wouldn't surprise us to dip down and touch our historical lows.
And that's because while the loan floors kick in, the deposit side faces just intense pressure.
Right, which brings us to the deposit side of the equation. Management noted that drop in non-interest-bearing accounts, it's just a reflection of depositors being keenly aware of interest rates.
I mean, when rates were zero, who cared? But now that has completely changed. Money is looking for yield.
And they gave us a great look into the industry backdrop by talking about deposit betas.
Okay, let's pause there. For our learner, what exactly is a deposit beta and why is it so critical right now?
A deposit beta just measures how quickly a bank passes along changes in the Fed's rate to its depositors. So a high beta means you, the customer, get paid more faster as rates rise.
Okay, got it.
And management said the last couple of interest rate cuts didn't lead to the typical drop in those betas, meaning even as the Fed cuts, competition for deposits is still really, really intense. The cost of funds has a structural floor under it.
So if organic growth is capped by pricing and deposit costs aren't dropping fast, where does management turn to drive value and, justify that 18.5% ROAE?
That is the perfect question. And that is why the capital discussion, specifically M&A, becomes the single most important narrative for 2026.
The bank's return metrics are strong. Management says capital is piling up rapidly.
And that raises the core tension we talked about. If they have, and I'm quoting, top tier returns, why risk holding on to capital instead of giving it back to shareholders with buybacks?
The market usually hates seeing cash sit on the sidelines.
But the answer is clearly M&A. They signaled they are actively exploring potential bank M&A to expand their footprint.
So they see that excess capital not as a pool for buybacks, but for optionality, for a big strategic deal.
Exactly. They are trusting that the market will recognize their total shareholder return over time, regardless of, short-term stock moves.
But the M&A market has been really tough lately.
Oh, for sure. And they were very candid about that. They said sellers still have really high valuation expectations, especially for what they called quality deposit franchises.
And what about the AOCI overhang, the unrealized losses on bond portfolios?
They said that's gotten a little better. But finding a deal that works without sacrificing credit quality is still a huge challenge. They said a lot of sellers were using hope as a strategy, but now reality is setting in.
And they made it clear that asset quality is non-negotiable.
And that's not just talk. They mentioned walking away from 2 deals last year, one in market and one out of market. After doing their diligence, they're willing to wait.
And this discipline explains the most critical capital decision they made. They are resisting the urge to do any meaningful share buybacks right now.
That's right. They see that capital preservation as essential to pull the trigger on an acquisition. They're explicitly prioritizing a large-scale accretive deal over any kind of short-term stock price support.
We should also touch on the non-core stuff that came up in the Q&A, specifically their oil and gas portfolio.
Right. When they got pressed on that, their response was surprisingly dismissive.
They called it a nothing burger.
A nothing burger, and an insignificant portion from the strategic view. They said the revenue from it is in a gradual decline over the next few years as they basically harvest the asset.
And from an expense perspective,
they're controlling the controllable. They gave a solid guide of $9.1 million in core expense for Q4, a core strength for this team.
So what does this all mean for you? The investor reaction was, well, it was measured. The stock popped almost 2% in the pre-market.
Yeah, but it closed the day up a much more modest 1.34%. At 43.72.
Which suggests investors liked the earnings beat, they liked the growth, but they are absolutely waiting for proof on durability.
They like the confidence, but the challenges are real. And the street is now focused on 3 key proof points for 2026.
Okay, what are they?
First, can loan growth stay healthy with all this pricing pressure? Second, will credit quality really stay better than it's ever been, like they claim? And third,
M&A.
Any concrete movement. The market is not going to wait forever for them to pull that trigger.
Especially when you look at the broader sector. The outlook for 2026 is for modest NII pressure pretty much across the board.
Exactly. Management's caution is basically validated by the macro environment.
Okay, it's time for our This Is Not Financial Advice segment where we pitch an outrageous but plausible trade idea based strictly on what we heard in the call.
All right. I'm calling this one the M&A optionality play.
Okay.
Bank7 is openly, explicitly telling you they are piling up capital for an M&A catalyst. They're foregoing buybacks to do it. The key insight is they're waiting for a quality deposit franchise.
And the stock is basically flat year over year, despite those incredible ROAE numbers.
Exactly. Down 1.8%, even with an 18.5% ROAE. The market is completely overlooking this capital optionality that's building up.
So what's the trade?
The outrageously plausible trade is to establish a long position, not for the organic growth story, which we know has headwinds, but purely as a leveraged bet on M&A.
So you're fading the stock's flat performance.
We are fading its current performance and positioning for a large-scale, accretive deal announcement that immediately realizes the value of all that capital they've piled up. This is pure catalyst arbitrage.
You're betting on a single event, the deal, not the slow grind of the underlying business.
That's the idea.
All right, to quickly recap, Bank7 delivered a solid EPS beat, confirmed double-digit loan and deposit growth, but gave really clear guidance that replicating 2025's growth is going to be a challenge.
All because of competitive loan pricing. And strategically, they are laser-focused on M&A, prioritizing that capital preservation over share buybacks to get a deal done.
They are running a disciplined, high-quality franchise. But that discipline, it seems, comes at a price in the current market.
It does. And we encourage you to analyze these specifics, especially that tension between their confidence, their top-tier returns, and the decision to hold off on buybacks.
So consider what stands out most to you. What is the true cost of optionality in a flat market? Is the patience for a big deal worth this temporary discount?
And just remember, this analysis is based on information provided during the earnings call and is strictly for informational purposes.
Until next time.